Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, well, we got a couple very big things. Today's action in the S&P was a bit of a non-event. The S&P closing roughly flat on the day, and the Qs ending up roughly 0.33%. But we know that most of the action was to be had in the after hours as we had major corporations reporting earnings, Microsoft, Meta, and Tesla. And yes, indeed, we will cover them in today's video. Of course, that being said, Meta is currently up about 7% in the after hours. Microsoft is down 6%, and Tesla just cruising here at about 2% positive in the after hours. So we'll be recapping all those earnings, and additionally, we will be doing ASML shortly as well. So those four company earnings we will be recapping today. Shout out to all of the companies reported earnings, but we only have so much time in these videos. So we'll be going over these four, and perhaps tomorrow we can catch up on some other ones. But we know tomorrow is a very busy day as well. MasterCard, Visa, Apple, and SanDisk will be reporting as some of your biggest names of the day. In other news today, we got a, well, non-interest rate cut. We had a Fed meeting today where Jerome Powell pretty much kept rates firm. So we'll be quickly glancing over exactly what was said in that meeting. It was, quite frankly, a nothing burger. We weren't expecting a rate cut. We didn't get a rate cut, but the commentary surrounding the economy was very interesting, so we'll briefly recap that as well. And in the rest of the video, we'll be going over some technical analysis, talking about our indexes, where we stand in terms of market rotation, the S&P, the Qs, some of our minor sectors. Thereafter, we'll be looking further into our list of big tech names here after, and deriving whether or not some of these plays are still in nice opportunity zones for either swing trades or long-term investments. And at the very end of the video, we'll be taking a look at our list of biggest gainers and losers, and taking a look at some names that are on the downside, trying to find if there's some trade opportunities or investment opportunities in this list of names to the downside, and also taking a look at some names that were very healthily up today is what I meant to say. So we'll take a look at some of these names and derive whether or not they are also some nice opportunities. And that's going to be it for today's video, guys. So we're going to cover a lot of earnings, a lot of charts today. So let's lock in and get going, shall we? So the S&P today, pretty much flat, down 0.01%. The QQQ's up 0.33%. And just a quick little check on the rotation. Well, it wasn't that good of a day in the market overall. People were largely on the sidelines anticipating whatever Jerome Powell was going to say in the afternoon. And of course, the massive big tech earnings that came after the close. And as a result, not much action here. Semiconductors getting a bit of love, but the rest of technology somewhat muted. Financials, also a bit of a muted day. Healthcare to the downside, and the bottom half of the market just not participating today. Consumer defensives pulling back a little bit, and industrials and everything below also a little bit muted too. Taking a look at your one-day relative, you can see that even better. A lot of your market segments were indeed down today. The only ones that performed well were basic materials, energy, and technology. Gold and silver having another record day during the session, and even a little bit more in the after hours, and we'll talk about that today, of course, as well. On the 1 week relative, we still are looking pretty healthy, guys, with most sectors in the market moving higher. The only ones lagging a little bit, industrials, healthcare, and real estate overall. You're currently in a greed environment, and the greed is not necessarily the sentiment, but only a few key technical indicators. You are still well above your 125-day moving average. Stock price strength in terms of net new 52-week highs and lows on the New York Stock Exchange is doing pretty good. It's in extreme greed territory right now because the market has been super broad over the course of the past few weeks and arguably the past month and a half. And as you can see, that stock price breadth as measured by the McClellan Summation Index, that is also in greedy territory too. So not too bad in terms of a greed read on the markets overall. And that being said, if we just take a brief look at some of our breadth indicators right here, percentage of stocks above their 20-day EMA, that took a bit of a dip today. However, you didn't really see the S&P falling off a cliff because a lot of big tech was kind of there to support the blow, right? In terms of the momentum kind of waning down here across the broad market. So percentage of stocks above their 20-day EMA, coming back to a healthy level. Usually when you come up to the 70 location, if you just pull this one out here, this is like 20 years of data, right? Whenever you come into the 70 location, that's usually when you can find a bit of a overall market pullback. But if a few key big concentrated names are there to kind of pick up the slack, well, the S&P doesn't really go down. And that's exactly what happened today. The Qs were the ones holding you up, more specifically, a lot of the Mag 7 big tech names, namely a lot of semiconductors and Google and Microsoft kind of holding it up, whereas Apple, Amazon, and Meta were a little bit lacking on the day. Percentage of stocks above their 50-day EMA, that also coming into the little bit of overbought territory right there. Between 70 and 80% is when you can see a bit of a winding down across the overall markets. I mean, just keep in mind, right, how the themes have worked this year. up until about, I would say, a week or so ago, it was the entire rest of the market and no big tech. That was kind of what was happening, right? Now, in the most recent 3-4 days, the rest of the market has taken a breather, and big tech has kind of been there to absorb some of that broader market pullback. Percentage of stocks above their 200-day EMA also still at a very healthy 61% read. So I don't see any red flags here, just very normal rotation between the various segments of the market. And that being said, before we get into more technical analysis, let us do a dive into some of our earnings today. And we're going to start it off with a fun one, ASML. Yes, it's going to be a teaser. I'm not going to do big tech right away. We're going to start off with ASML. So ASML coming out with their earnings this morning before the open. And although the stock did move substantially higher after that earnings print, they kind of consolidated into the rest of the day. And this was kind of to be expected. Now, ASML did have really good numbers, but keep in mind, guys, the stock was up like 35% over the course of the past quarter. It was kind of overbought on the weekly time frame here. The monthly is very extended as well. So in the event that they did not report an absolutely perfect quarter, well, you could get sent to the downside. That's kind of exactly what happened today. Their numbers were very good, but just not crazy perfect with insane forward guidance, the likes of which we're seeing from companies like Micron or some of the memory players, right? So we'll go over the earnings and we'll also describe why this is still one of my favorite bets in the entire market, but why we might just have to be a little bit reserved in terms of purchasing the stock all the way up here in the $1,400 range. So taking a look at the ASML earnings, a 1% miss on EPS, not good enough to sustain a 35% rally in the past quarter, and a nice 3.77% beat on revenues. Now, the highlights for this quarter for ASML definitely was in the guidance. So taking a look here at our some of the numbers, excuse me, no, that's not the one, that's Tesla. I should have done Tesla first. It should be this one right about there. My bad. ASML up here. No, 5% beat on revenue year over year. Pretty good. Net bookings. This was the highlight of this quarter, guys. Up 86% year over year. Very strong. Operating margins also very strong as well. They also gave an increase over time for operating margins and gross margins into 2030. So good visibility right there. And EPS was up 7% year over year. So not record-breaking numbers in terms of revenue or EPS, but net bookings and that backlog of pipelines was absolutely massive. Take a look at some more highlights right here. Your fiscal year order backlog for 2026 stands right now at 38.8 billion euros. The expectation was 33 billion. So this was the big beat that everybody was looking for, right? Is the business moving forward in a substantial fashion as part of the AI trade? And the answer is yes. The backlogs are pouring in right now, or rather piling up. New share buyback program up to 12 billion euros by December 31st, 2028. This is brand new. They've just completed their most recent $7.5 billion buyback program over the course of the past 12 to 18 months. So now they issued a new one, very strong. We know that ASML is a big buyback player. Here are your shares outstanding since the peak back in 2013. You can see they buy back shares virtually every single year. So looking pretty good on that front as well. Making another move here, plans to streamline technology and IT organizations, plans to cut 1,700 jobs, which is 4% of their workforce, unfortunately for those people, but it will translate to higher operating income and higher operating margins for the business. Fiscal year guide, your sales guide coming in higher than anticipated, 34 to 39 billion euros. The midpoint there should be around 36.5, which was above the estimate of 35.15. That was a nice beat for the full year. And gross margins, 51 to 53%. That, however, missed the mark. So there's a few little misses here on margins, right? In terms of they missed on EPS, they missed on their fiscal year guide for gross margins, and the Q1 guide is kind of more of the same. Net sales estimate for this quarter, they raised 8.2 to 8.9. The estimate was 8.13. And gross margins here, as you can see, 51 to 53%, which is slightly below the estimate of 52.5. So revenues, backlog, very strong, but a few key metric misses on margins. And that's enough to bring a stock that was up 35% over the past quarter down just a few percentage points after their most recent earnings release today. They did give us really good visibility in terms of the 2030 opportunity. Annual revenue, they gave us a super wide range between 44 billion to 60 billion. I would have enjoyed that to be a little bit more tight, but still the top end of that is quite substantial, with gross margins improving from 56 to 60%. Keep this number in mind when we take a look at their gross margin history in the upcoming slides, because it will matter a whole lot. Commentary right here by management. In the last few months, many of our customers have shared a notably more positive assessment of the medium-term market situation, primarily based on more robust expectations of the sustainability of AI-related demand. This is reflected in a marked step up in their medium-term capacity plans and in our record order intake. So more visibility from ASML, which kind of matches the visibility that TSM gave us just a few weeks ago, right? These picks and shovel companies, they have all the order backlogs, they have the data, and if they're telling you that times are good, well, times are very good indeed. Moving on to further slides from ASML, total net sales by end use, you can see that all of their product suites are moving substantially higher, whether that's installed base management, also known as their services division, because not only do they sell these massive machines, but they also do a lot of servicing for those machines, right? So installed base management segment moving higher, and their logic and memory divisions as well, very strong by the company. Of course, capital return to shareholders, just a reiteration that the company does pay very decent dividends, but also does a ton of share buybacks. So here's your total cash return to shareholders. You'll see that most of that is done through share buybacks with some dividends paid as well. ASML not known as a very strong dividend paying company, but still it's nice to see that they do favor cash returns to shareholders. Once again, keep in mind these gross margin estimates, right? This Q1, 51 to 53, and fiscal year 2026, 51 to 53 as well. Why this matters a lot, guys, is if you take a look at some of their gross margins over the past few quarters, you'll see it kind of varies between the low 50s, right? Let's call it 51 to about 53, 54. That being said, when they tell you that they're increasing guidance right here through 2030 to 56 to 60%, that is very nice efficiency gains, right? It's not massive, but it is definitely something to pay attention to. So as a result, your operating margins will go up too, your net margins will go up, and ASML already makes a very decent amount of net margins. This quarter so far, 29.2%. So not only does this business have a very strong moat and large competitive advantages, it's also a very strong business in terms of free cash flow generation and net income generation too. So keep that in mind when you're looking at ASML. Moving on a little bit further here, AI is going to reshape semiconductor demand this decade. AI demand for compute density and high bandwidth memory is growing 2 to 3 times faster than overall semiconductor sales. Yes, ASML also makes machines that do cater to manufacturing memory chips as well. And you can see here that the divergence between non-AI memory and non-AI compute growth rates, which through 2030 will have compound annual growth rates of 7% and 6% respectively. Look at AI memory and AI compute. This is where all the growth is, right? 24% to 28% compound annual growth rate for AI memory, and AI compute 22%. But notice this, AI memory is still the strongest segment for growth through 2030. So this is good visibility provided by ASML right here. We've heard from Micron not too long ago. This is just another reiteration. And lastly, the good old bookings chart for ASML, super strong numbers, guys. You can see that this net bookings amount garnered in the most recent quarter really dwarfs all of the previous quarters combined. Well, not combined, but it dwarfs the size of any quarter that you could choose since 2019. So very strong backlog currently being built up by ASML. I really enjoy this company a lot. However, there are times to buy things, and then there are just times to hold things. And in my opinion, this company is currently at a hold. If you take a look at the valuation with these earnings in mind, at 1440, you're currently sitting at a 43 forward price to earnings ratio. And that gives them a 2.29 peg. They do have 19% EPS growth, and they also have a 13 forward price to sales. This peg ratio and this price to sales metric, they're expensive, guys. The stock not too long ago was half the price. So just cut these numbers in half, and now you know why back here I was saying the stock was such a buy. It was trading at mid-single digits forward price to sales, and also trading at like a 1.1, 1.2 peg. And back here, I was pounding the table that ASML was probably one of the best buys in the market, and it was. Up here, for me, it's just a hold. It's not really a sell, especially if you're planning to hold it for its moat and its competitive advantages. Maybe if you're trading in and out of things, you could justify selling off a little bit and possibly repositioning into some other plays that represent better short-term value, but I see no problems with this company. Keep in mind, it has a very wide moat, strong competitive advantages. It is, so to speak, a long-term compounder. EPS is very nice over the next 4 years, and revenue growth is also very nice. It's just the valuation right now is a little bit steep for initiating net new buys. but maybe, who knows, if we ever revisit the $1,000 location, I might be tempted again. You never know, right? They sometimes have these big declines, and I'll be waiting for one of those to add any more shares, but I'm not buying anything more up here. I am full on ASML. I'm just going to hold what I have. So keep that in mind if you're looking to invest in this company. It is not very cheap right now. As a matter of fact, it's running at some of the most expensive valuations that it's had over the course of the past 5 years, but a very strong company nevertheless. That's everything for ASML earnings. Now let's jump into company number 2, which is going to be Tesla. So Tesla coming in after the close today, and true to Tesla's fashion, they missed on virtually everything you can possibly imagine on the car business, but the guidance for FSD robotaxis, their energy business, and Optimus was very strong, especially on the earnings call with Elon Musk, as he usually always does, talking about the trillion-dollar forward opportunities of every single one of those other lines of business. Now, Tesla is currently in a pivot right now. They're pivoting away from their traditional electric vehicle business where they sell to the consumer, and now they're trying to scale the commercial robo-taxi business. And as a result, you have a few key meaningful things that came out, especially on the earnings call. Now, I don't know if I wrote it down right here, but Tesla will now be ending. They will now be, oh, I did write it down right here. They will be stopping production of the Model S and the Model X. No more Model S and no more Model X starting next quarter. Additionally, they put out a nice $2 billion into an XAI investment. Those are two things that you probably won't see in some of the earnings slides. However, two very notable things, and they do reiterate the pivot that Tesla is currently doing right now, right? They're pivoting away from some of their least selling models, retooling the factories essentially for more Model 3, more Model Y production, and also Cybercab production and Tesla semis as well. So speaking more about Tesla, let's jump into some of the numbers from the company real quick. Tesla, you can see revenue was actually down 3% year over year. Unfortunately, storage deployed, a highlight of the business, 14.2 gigawatt hours, 29% year over year. This is the fastest growing component of Tesla's business so far, at least currently. We're not talking about in the future in terms of Optimus and Robotaxi. The energy business has the numbers right now. Supercharger stations remains up at 17% year over year, and operating income, once again, a bit of a pain point for Tesla, down 11% year over year. Operating margins as well have kind of gotten crushed over the past 6 quarters or so, right? Taking a look at some more numbers right here. Segment performance, just to break it all down for you. Their total automotive business was down 11% year over year. Energy generation and storage, that was the highlight, 25%. As we said, services and others, which does include the new FSD subscriptions, right? And obviously the regulatory credits that are kind of being wound down right now, that was up 18% year over year as well. Total deliveries for their car business were indeed down as well, 16% year over year. But active FSD subscriptions, that was up to 1.1 million active FSD subscriptions, up 38% year over year. Very strong. They also have a very substantial cash position right here. Cash equivalents, and investments, $44 billion, up 21% year over year. However, on the earnings call, they did say that they would be spending about $20 billion in CapEx for factories, the lithium production as well, and their AI compute division too. So keep that in mind, guys. They will be touching into their cash flows to do that. Their free cash flows, not that their free cash flows are what they were a few years ago. However, they might have to dip into a little bit of this cash reserve as well. But good thing Tesla does have a lot of cash on the balance sheet to do that, right? So moving on further, starting this quarter, we are transitioning access to FSD supervised to monthly subscriptions only. Cybercab, Tesla Semi, and the Megapack 3 are on schedule for volume production starting in 2026. And this will be the focus point moving forward, right? The Cybercabs and the Tesla Megapacks as well. Optimus only end of 2027 at this current stage. Moving on to some of the highlights from the earnings slides, you will notice here a few key metrics. Total GAAP gross margins, these were actually higher, 20.1%. Not bad, better than at least the past year's worth of data. Operating margins, although still thin and not what they were just 2 years ago, not too bad, 5.7%. I mean, if you look at what they were back in the day, right? You know, they used to be like, in the teens, and now they're down to about 5.7% as the automotive business kind of slowly dwindles a little bit. And we know why. We've talked about it many times on the channel. Free cash flow, $1.4 billion, which is not too bad, but once again, a far cry from the free cash flows that they were generating in years prior, such as, 2021, 2022, and even 2023 at some points, and their cash position is very strong. This is the year-over-year comparisons. You'll see that the energy storage business is the best performer here. Look at this ramp in revenues for the energy business, right? 2021, $2.7 billion, now all the way up to $12.7 billion. Very strong. And this, in terms of automotive revenues, guys, this is the first year in Tesla's history where you have year-over-year declines in total automotive revenues. But we've talked about this, right? Tesla is currently undergoing a big pivot from people driving their own cars to cars driving themselves. It's really just that simple. But then also you have the energy storage business. You have Optimus coming out, but no revenues for Optimus just yet. But obviously Tesla, at least Tesla investors, are very forward-looking in that respect. Total revenues also declining year over year, down 3%. This is also one of Tesla's first years where you're seeing a total revenue decline, right? Moving on a little bit further here, in terms of active FSD subscriptions, this is a highlight. You can see that quarter over quarter, they have been increasing sequentially, 1.1 million active FSD subscriptions, and your total gigawatt hours deployed during the quarter also hit a record high of 14.2 gigawatt hours deployed, much better than Q3, which was already a record quarter. So not too bad, guys. And then we can talk about supercharger stations and connectors, of course. Those were also at record highs too. Moving on a little bit further here, your total active FSD subscriptions year over year comparisons. We're going over in this table, right? 1.1, 38% year over year. Very nice increase, right? And now it'll only be on a subscription basis. You might remember a time where you could purchase FSD one time for one price. No longer can you do that. It's now going to be roughly $100 per month. And total storage deployed through 2025, 46.7. Now, Elon has said that they're working towards over 100 gigawatts of total storage deployed over the next 2 years. So this should continue to be a very solid ramp for the company. Now, a few things that are very noteworthy for us here, guys. What we're going to do is talk about the robotaxi, right? Because it's obviously very important here. So robotaxi here, as you can see that right now, San Francisco Bay Area, currently with a safety driver. Austin is ramping unsupervised. They're very proud about that. And look at all these end markets that they're trying to target in the first half of 2026, talking about Dallas, Houston, Phoenix, Miami, Orlando, Tampa, and Las Vegas. So people are definitely looking forward to that overall. And here are your cumulative paid robotaxi miles. They're currently now up to 600,000. And as they ramp into more cities, it could be very healthy as well. So very strong, guys. Obviously, we're not going to go through every single element of Tesla's earnings, only the ones that matter most to Tesla investors, which should arguably be how much progress they've been making on FSD, which can be seen from the implementation in robotaxis as well, right? In terms of how many end markets they're going for. But all of these guys, right? So if I had to show you guys visually what Elon was talking about on the earnings call, because yes, I do listen to all these earnings calls, and that's why I upload the videos so late sometimes during earnings season. So Tesla right now has a car business that's kind of doing like this. I mean, don't take it from me. I'm in Tesla as well, guys. I've held this company for many years. I've sold out a lot of profits so far, but I'm still holding a number of shares. So if you take a look at the business, right, it's changing. You see, vehicle deliveries right now, it's been flat or declining for a better part of the last 2 years. Their operating cash flows kind of peaked here and are declining as well. Your free cash flow metrics also, I mean, they're okay, but still not expanding consistently. And here you go. Here's net income, the columns in blue, declining over the past 2 years. Adjusted EBITDA, declining over the past 2 years. Why? Well, here, a profitable segment of the business for them is the energy storage business and their services portion of the business. Those are doing well. But the car business did this and now is kind of doing this, right? However, while this is happening, and this is why people are so focused on this stock, how can Tesla be up 1% in the after hours when their car business is doing so bad? Because people aren't focused on this anymore. Tesla is making a big pivot. What are they pivoting to? The energy business that's doing this, and you're kind of like currently here in the inflection point before, well, they're ramping really well right now, but also you have other verticals that they're ramping, right? Robotaxi is going to be the big one, and you're like here, right? Optimus is further down the line. Optimus is like 2027. So the curve will start here, and then you have the exponential logarithmic curve to the upside, right? And Optimus is here. So although this segment of the business has peaked or plateaued and slightly coming down, well, the energy business, right, is doing very well. The robotaxi business is doing very well, right? And they're scaling it. And then the Optimus business, that's the big one that's coming in the future. So people are focused on this. They're not focused so much on this anymore. Now, you may disagree, right? And as a result, you may not be an investor in the stock, but I'm just coming to you for people that are invested in the stock. What are they looking forward to? And how can the stock hold up these valuations? Because when you look at these valuations, they're pretty crazy, right? At $445 right now, roughly where they are. Right now, they're at a 208, 209 forward price to earnings. They're growing EPS. This is true, but keep in mind they got a hit on EPS recently, so they're coming off of a lowered level. As you can see right here, the decline in EPS and now a reacceleration. Where do you guys think all this EPS is coming from? It's not coming from their car business. It's coming from a higher margin business, right? That's going to be robotaxi, potential Optimus is included in here as well, and the energy storage business as well, and obviously FSD subscriptions, right? The revenue business ramp as well, that's not coming from the car business. They're not forecasting a reacceleration in the car business. No, this is all coming from the businesses down the line. So although, yes, it has a massive forward price to earnings ratio, it has a 5.75 PEG ratio, and it has a 13.4 price to sales metric, depending on what type of person you are, when you look at this stock, if you think it's only a car business, this looks like the most expensive car business on the entire planet, and it doesn't make sense to you. However, if you give some credence to the forward ramps or the forward business model ramps that are currently underway at Tesla right now, this valuation could be justifiable. Yes, you have to extend your valuations into 2030, 2035 to encompass the sheer scale of those businesses: robotaxi, FSD to end consumers, the energy business, and Optimus robots. This is true, right? But if you model that far out, you can make sense of this valuation. So as we always say on Tesla, my job is not to tell you whether or not the stock is a buy, because it's a very polarizing stock. If you are a person that only views it for the car business because those are the numbers that they have right now, cars and energy and subscriptions, then you would think it's very overvalued. If you believe in the future ramps that Tesla currently has underway, well, you might also think that this is a cheap stock price, and you may believe Elon when he says that Tesla can be a $5 to $10 trillion company. And to be quite frank with you, if the thesis does come true, if the robotaxi ramp comes true to the scale that he thinks it will, if the Optimus in every household thesis comes true, and we don't doubt that Tesla has some of the best robotics on the planet and that they do have the factories to pump out that scale. Nobody else can actually pump out that sheer scale on a level that Tesla can, right? But it's all about adoption rates. So Elon says Optimus end of 2027. He talks about the massive FSD ramp this year, but also millions on the road by 2027 as well. And I've been in Tesla, guys, since like 2018. So I can tell you all about Elon's timelines. Usually whenever Elon gives you a timeline, and this is a meme within the Tesla community, even the most diehard Tesla shareholders will tell you as much. Whenever Elon gives a timeline, suffice to say, you may as well just double it, and then that's the actual timeline, right? But still, the stock price is holding up its current price right now, so I will leave you with this current fact right now, right? I will leave you with what Elon has been saying on almost every single earnings call over the course of the past 4 or 5 quarters. If you do not believe in the long-term vision for Tesla, then do not invest in this stock. It's very simple. If you believe in the long-term vision, you will think it's cheap right here, and the time frames would look pretty good in terms of this monthly breakout capacity, right? However, if you don't believe in the stock, or you don't believe in the long-term vision, then maybe you just don't want to pay attention to it at all, and you would never touch this company. I will leave that up to you. Tesla, I do have still as a position. It is nowhere near as big as it once was when I sold most of my shares in the 2021, blow off top back in the day. I haven't really bought them back at all. I'm just still holding for the long-term vision. It's not a very large position for me anymore. Maybe, dare I say, 3% of the portfolio, something like that. A lot of the Mag 7 names are much bigger for me at this current stage, but I still do have something for the long-term thesis. But once again, it will take years to play out, not weeks, not quarters. It will take years. So that's everything I had for you guys for Tesla. Spent a little bit more time on it because I know Tesla is a very polarizing stock. Either people absolutely love it or people absolutely hate it. The decision is yours. Now let's move on to stock number 3 as part of our earnings crew. It's going to be good old Microsoft. Now Microsoft had a bit of a flat day, but unfortunately fell even more flat in the after hours. The stock is currently down 6 to 7% in the after hours. Why? Well, the reason why is somewhat confusing. You can see it was straight an algorithm dump right after the earnings print, but to be honest with you, there really was nothing wrong with these earnings. There was a few little things that were said during the earnings call, but the algorithms didn't have the earnings call right at the time where Microsoft reported earnings. So let's dissect Microsoft earnings and see whether or not the company is a decent proposition to buy. You might remember me just a few days ago saying it was a very good buy in the 450 to 440 level. Little hint, it still is a very good buy even after this earnings drop, and I will be excited to pick up more shares, but let's talk about the earnings print. So 6% beat on EPS and a 1.2% beat on revenue. Now, when we take a look at some of the numbers here, revenue was up 17% year over year, very solid. Microsoft Azure growth, that was up 39% year over year, very strong. However, maybe Wall Street was disappointed that it wasn't sequentially higher. Here, last quarter was 40%. So a little bit of a downswing here to 39. I mean, that's not that big of a downswing, but it is something, I guess, right? Operating margins were also very strong, but also a sequential slight decline from last quarter. So maybe something there as well. Although operating income was up 21% year over year, very solid print by Microsoft, and EPS was up 60% over year. Yes, but this is fake news. This is them realizing some of their investment gains mark to market from their OpenAI investment. So this EPS is a bit of fake news. So keep that in mind when we move through the rest of their earnings. Now, some highlights from Microsoft's division. The Productivity and Business Processes division was up 16%. Decent gains here from Microsoft 365 Commercial Cloud, 17%, 365 Consumer Cloud, 29%, 11% gain on LinkedIn, and 19% up on Dynamics 365. Talking about Intelligent Cloud right here, you'll see that was up 29%, very solid growth, 39% from Microsoft Azure and other cloud services. Very strong number, nothing wrong with this number whatsoever, right? The point here that may also have led to a bit of a decline in the after hours is the personal computing division. Unfortunately, that was down year over year, down by about 3%. That was the only, red flag in my, it's not even a red flag because it doesn't mean that it's going to happen over and over, right? But it was a bit of a pain point here. Windows OEM and devices, that was only up 1% year over year. Xbox content and services, down 5% year over year. Search and news advertising, though, that one was indeed up 10%. So a bit of a mixed bag here in the personal compute segment. Moving on a little bit further into Microsoft's earnings slides, as you can, or rather the earnings numbers, you can see that they had a very massive bump in terms of commercial RPOs, 625 billion, up 110% year over year. However, this is Oracle all over again, isn't it? Most of this comes from OpenAI. So I put down a little bit of notes right here. Of that $625 billion commercial RPOs, 45% of that increase was from OpenAI. After all, remind you, OpenAI said that they would buy $250 billion of Microsoft Azure services. So these RPOs, is OpenAI going to be able to actually foot the bill or not? But they also do have $30 billion in commitments from Anthropic, which is, in my opinion, more realistic, so to speak, right? So, maybe Wall Street having a bit of a problem here with the sheer size of RPOs and not willing to take it to the bank, so to speak. So just keep that in mind as well when we're looking at Microsoft content right here. They did have $12.7 billion of return capital to shareholders via dividends and share repurchases as well. Some commentary by the CEO. We are only at the beginning phases of AI diffusion, and already Microsoft has built an AI business that is larger than some of our biggest franchises. We are pushing the frontier across our entire AI stack to drive new value for our customers and partners. CFO commentary, Microsoft Cloud revenue crossed $50 billion this quarter for the first time, reflecting the strong demand for our portfolio of services, and they did indeed exceed expectations across revenue, operating income, and earnings per share. So to be honest with you guys, it was not a bad report, but we went over a few little things here and there, right? The personal compute division being down a little bit, the RPO number here being a little bit questionable, the EPS number here bolstered by their mark-to-market gains from their OpenAI investment. So not everything is picture perfect for Microsoft. Does it deserve a 6% down in the after hours? Probably not, but you guys know That's the market for you, right? Earnings are always a casino. You're never too sure what you're going to get. Moving on a little bit further here, we do have some Q3 outlooks. Now, I know it says Q3. It's actually for Q2, but Microsoft, every company runs a little bit different fiscal years. This is just for next quarter. That's what you should understand, right? If you take a look here at Microsoft commercial cloud revenue growth between 13 to 14%, which is good. Pretty good, right? But lower than the numbers that we have had. Gross margin percentage is also pretty good. Their consumer cloud revenue is going to be mid to high 20s percentage growth, which is very strong. Microsoft Azure. Now, here's where Microsoft performance in the after hours was a little bit awkward, right? They had that 6%, 7% drop initially, recovered it. Then this second drop came from the guidance, because Microsoft always gives guidance on the earnings call, never in the actual print. So during the earnings call, there's a few things that were said. Number one is this little slide right here. If I can find my slides again. Sorry, I got too many tabs open right now. This one right here, Microsoft Azure, right? Growth between 37 to 38% in constant currency. So something else, right? Now they went from 40 to 39, and next quarter it will be 38 to 37. Is that bad? No, I mean, objectively speaking, guys, like 37 to 38% is insane. It's the law of large numbers eventually. You can't keep growing a business 40, 41, 42%. Eventually, you will have a growth slowdown. Microsoft Azure is already currently a very large business. I mean, the CFO said it from the most recent thing we just read, right? The cloud revenue is bigger, right, than some of their entire lines of business already. So, keep that in mind when we're talking about that one right there. But this also, and then server products revenue decline in low single digits. Now, they also said some things about memory and about CapEx. So they said that they might have some margin impediments because of the increasing costs of memory. That was said during the earnings call. I'm sure you might see it if you're browsing around social media. But then again, right, that's not the major reason for the drop overall. And that's pretty much everything. In terms of CapEx, guys, CapEx guidance will remain somewhat strong into 2026 as we kind of move on as well. So please keep that in mind too, because Microsoft is still, and they talked about this so much on the call, guys, they're still supply constrained. This is a very good problem to have. And as a result, they will be investing a heavy amount of CapEx. The guidance per se, well, they just did $37.5 billion of CapEx in Q4. This was above what the street had anticipated by about $3 billion. Street had it about 34. So this increase in guidance in CapEx over the last quarter, you can take it one of two ways, right? You can take it as that the supply is so constrained that they have to spend even more money, which is a good thing. Or you can take it negatively and say, well, they're spending still so much money. Will they ever see a return, right? So you see, you can always take things two ways in the market. And the guidance for next quarter is roughly the same. Roughly the same. They said roughly the same or slightly less than the current quarter that they just had. So keep that in mind. They'll be providing us guidance on a quarter-to-quarter basis. Still no estimates for the entire year. So that being said, guys, right? Microsoft down 6% in the after hours. Is it a buy down here at 450? I truly do think so. Nothing fundamentally wrong with the earnings presentation from Microsoft. Just a few little elements which we touched upon already. At 450 right now, valuation of Microsoft is fine. It's a 28 forward multiple, which is fair. It's a 1.5 peg also, which is fair. So that being said, guys, right, the growth and the EPS growth and the revenue growth for the business is very strong. There's really nothing bad to report right here. Smooth and consistent EPS growth for Microsoft. Smooth and consistent revenue growth as well. The downswing in the Microsoft Azure cloud growth is not that meaningful either, right? It's just that they hit their peak at 40 and now will be moving incrementally lower, but the number that they're growing it on is a higher number, right? So if you're making like $40 billion and growing that, 40% year over year, eventually you'll hit $45 billion. And then from there, you grow at 38%, which at that point is going to be, something like $60 billion. I'm just throwing out numbers, but just, it's going to move like this, right? The growth rate is going to taper off, but the absolute number will just keep going higher and higher and higher. So please just keep that in mind. It's the law of large numbers, catching up with them a little bit right there. Not too bad. And Q1 guidance as well. We had some guidance for revenues on the call. 82 billion in forward guidance for the quarter. The estimate was 81.19. So not too bad, guys. To be honest with you, it was a very decent call. And as a Microsoft shareholder, I'm happy with this one. Even though the stock is down 6% in the after hours, I do believe this 450 to 440 location right into former resistance, which is current support. And you guys know it's still down now in the after hours, 20% from the peak, with very solid fundamentals. You usually don't find Microsoft around its 26 EMA. So once again, I do believe this to be a very nice buying opportunity for a very solid company, but an unfortunate earnings decline once again for Microsoft. This is now the third time in the row where either they go up and go down, go up and go down, but this time they just kind of went down. So sad, right? Sad. Everybody would have wanted Microsoft to push up here, but at least we can't say that there's a fundamental problem with the business. And that's the most important thing, is being able to recognize whether some of these earnings dips are buying opportunities because there's nothing wrong with the business, right? If there was something wrong with the business, I would definitely tell you, and I would say, well, maybe it's time to stay away. But at this point in time, there's nothing wrong. It is a buying opportunity, at least in my opinion, not financial advice for you. That's everything for Microsoft earnings. And now company number 4 is going to be good old Meta. So Meta coming out with some earnings today, and you can see the stock rallied really, initially though, in the first 2 minutes or so, it declined and then pushed up really nicely, getting as high as about 10%, 10.5%, and then kind of gave back its gains a little bit slowly, ending the after-hour session at about 7.5%. So Meta had some really strong numbers. But to be honest with you guys, I listened to the call and there was really nothing special. Now, Meta has been kind of beaten down over the past quarter or so, right? To the point where they were fundamentally cheap. And we've been kind of pounding the table on this one. I redid the valuation, but excuse me. We were pounding the table. Every time every time Meta was low 600, I was saying, guys, this stock is clearly a buy, right? They had a bit of a mishap last quarter in terms of a one-time tax implication from them, $15 billion, which did impact their EPS and impacted their net margins. And obviously, they had raised the CapEx and the expense profile. And Mark Zuckerberg really didn't have an answer as to why he was raising that CapEx guide. Was it really all going to be for advertising purposes? Or was he going to do something else with it? Like in terms of building out the Llama model that they're working on, their Reality Labs division with the glasses and the metaverse and that good stuff. Like what was the $100 billion of CapEx going to be spent on? And that's what I was looking for in this earnings call, for Mark Zuckerberg to tell everybody exactly what the plans were. Unfortunately, though, we didn't really get that. It was a bit of a strange call where if you listen back to the call, analysts were asking Mark Zuckerberg, like, hey, you guys came out with some news recently that you were going to explore offering cloud services. Can we hear more about that? And Mark Zuckerberg, literally 3 analysts back to back, he literally said, well, I don't think that now is the time to be talking about that. All I can say is that it's currently in motion and we don't want to focus so much on the snapshot in time right now, but we'll be focusing on product rollouts over time. He was very mysterious about the whole thing. I was expecting concrete answers, but Mark literally said, almost word for word, I'm paraphrasing a little bit, but he said, it's not the time to talk about that right now. It's like, well, when is the time to talk about it, Mark? Like, this is an earnings call. Should you not be talking about it right now? I was very confused. But that being said, the street did enjoy the numbers overall. So let's take a look at some of the numbers here from Meta. Some of the easy numbers, revenue, very strong here, guys. 24% revenue increase year over year. This is some of the best revenue increase year over year that this company has had arguably in the last 4 to 5 years. Family daily active users was up 7%, 3.58 billion people. Can you guys understand that they literally have almost half of the entire planet as daily active users between Facebook, Instagram, WhatsApp, and Threads? It's pretty crazy, right? Operating income was up 6% year over year. That was okay. And EPS was up 11% year over year. Operating margins also slightly little uptick sequentially from the last quarter. A few more numbers from Meta right here. Look at this big CapEx number. The street was expecting 110 billion for CapEx for this year. And then the team said, no, it's actually going to be more, 115 to 135 billion. And to be quite honest with you, I'm very surprised that the stock was able to hold up the gains when Mark Zuckerberg didn't really do a good job of justifying this CapEx spend. I mean, I'm sure that a good percentage of it is going for their advertising gains. The company did highlight that there was a lot of efficiency gains here from, just advertising targeting because of the efficiencies obtained in the advertising algorithm for Meta. But it would have been fun to hear a little bit more about the new cloud services division that they are building out. But maybe I'm speaking too much about this. My apologies. The guidance for Q1 revenues came in stronger than expected. 53.5 billion to 56.5 billion is the range. The midpoint, of course, would be 55. That was well above the estimate of 51.27. So this is another reason why the stock jumped. Not only was this revenue and EPS beat very strong, but this guidance for Q1 was also very strong too. You can't lie, right? The numbers were very good. And fiscal year total expenses, 162 billion to 169 billion again. So a lot of expenses for Meta, but supposedly they are for good purposes for the company. They're not burning money anymore. Free cash flow was also a very nice highlight here, 14.08 billion, which is very strong. And so far, no share repurchases, as most of that free cash flow is going towards more capital expenditures overall. But we had some nice things. The algorithm, advertising algorithm efficiencies are obviously working, because you got ad impressions up 18% year over year, and the average price that Meta is able to charge per ad is up 6% year over year as well. So here you go, some quotes from good old Mark. We had a strong business performance in 2025. Thank you, Mark. I'm looking forward to advancing personal super intelligence for people around the world in 2026. Okay, we expect, sorry, we already read that. Despite the meaningful step up in infrastructure investment in 2026, we expect to deliver operating income that is above 2025 operating income. So once again, being very mysterious, not providing an overall number, but saying in spite of these heavy capital expenditures and a very lofty operating expense profile, they will deliver better operating income than the year that just passed us. So at least that's good, right? They are seeing some revenue efficiency gains there. And that's pretty much a lot of your highlights. Now, if we move into some highlights from the earnings presentation, you can see that Meta's advertising business, guys, has never been at question here. Advertising revenue by user geography. Look at Q4, man. What a strong quarter for Meta. $58 billion. And across all geographies, very clear improvements. Q4 is usually their best quarter, excuse me, but this is a monster quarter from Meta. No secret there at all. Moving on a little bit further here, you can see that their segment results, once again, the advertising business is driving a lot of the gains. The Reality Labs revenue continues to kind of be very soft in relation to the rest of the business. I mean, they made almost $1 billion this quarter, but in the process of making that $1 billion, they burned $6 billion to make that happen. However, one highlight from the earnings call is that they did say that this is going to be the peak of expenses for Reality Labs. They are pivoting a lot of the Reality Labs funding from the metaverse to glasses and augmented reality glasses and their virtual reality headsets. A lot of that's being spent on the Meta Ray-Ban glasses as well, but we also know that they have an upgraded version of the Meta Ray-Bans, which gives you like a little display screen, kind of like true AI glasses. So at least they'll be pivoting away from the metaverse. And he did say that, these expenses for Reality Labs, this would be the peak into this year, and then thereafter, those would be coming down. So the street did really enjoy that. That's probably another thing that contributed to Meta being up in the after hours right here. You can see the expense profile as a percentage of revenue. Despite the massive expenses that Meta has been incurring, it's still somewhat similar as a percentage of revenue, right? Not that bad. Okay, moving on a little bit further down here, net income, very positive right there. You can see this was the crush after the tax expense last quarter. But, if we removed it, let's just say this quarter never happened, okay? It is moving up sequentially and year over year. So very strong numbers by Meta. Moving on a little bit further right here, family daily active people, we already talked about it, but streamlined up and to the right is exactly what you want to see. And then family average revenue per person, a very widely looked at metric by Wall Street, also up to 16.56. Very strong increases by Meta, guys. Sequentially quarter over quarter, but also year over year, a net increase here on the good old ARPP. So you also have some nice numbers here in terms of ad impressions, whether that's worldwide or just US and Canada, Europe, Asia Pacific, or the rest of the world. You can see that Meta, they must be doing something right with all that CapEx spend and utilizing all those GPUs to really make the algorithm for ads more efficient, because they talked about, organic imprints and things of that nature across threads and across reels and things of that nature. And they had some really good results. So it was a very strong quarter from Meta. There's really nothing bad to say. It's just I would have enjoyed more visibility in terms of the cloud business that they told us that they were going to do like 2 weeks ago. Sadly, Mark Zuckerberg was being a little bit mysterious on the call. So maybe he's just saving these releases when he can release a bit more of a clear roadmap. Because the way he was talking about it, right, is that like these things are in motion. They're obviously working on something, but he didn't want to provide a clear timeline or a clear list of products that they were working on. So, take from that what you will. But the numbers don't lie. It was a very solid quarter, 38% net margins from the company and $14 billion in free cash flow. the ad business for these guys, it just prints money, right? And this is the main reason why you invest in Meta, is because of the advertising business, you know? Now at 7:15, where they currently stand in the after hours, right about here, is Meta still a buy? Well, we know it's a screaming buy down there. Is it still a buy? Well, as a matter of fact, it is still a buy. At 7:15, you're sitting at a 24 forward P ratio. That's a 1.71 peg in light of this revenue and EPS growth in the future. It's a 7 forward price to sales. Not a bad free cash flow yield either. Meta is a very strong company in spite of the amount of money they're spending on CapEx and their expense profile. Operating incomes have now been guaranteed to be higher next year than this year. At least that's per the CFO and Mark Zuckerberg himself. And as a result, EPS will continue to climb very nicely, and the revenue will continue to climb as well. And you will notice that most analyst price targets are cleanly above the current share price. I would not be surprised if Meta is a $900 to $1,000 stock at some point towards the end of the year in 2026 and in 2027. So I am a firm believer that this is still a very nice location to buy Meta. But let's be honest, guys, it's kind of last call, right? Anything 700 down to 600, this little pocket that I've been buying my shares in, that is the buy zone, right? Don't ask me the question when it comes all the way up here. At this point, will Meta be a buy because you waited for the breakout confirmation? No. If we're long-term investors, the buy area is still right now. And this earnings report did make me very happy as a Meta shareholder. Now that is everything I had for you guys for the earnings reports. Hopefully you guys enjoyed those. I know we spent a lot of time on them, but such is the nature of days where we have big tech releases. Now, moving on to our index analysis right now, just slightly before we do that, we will recap a few highlights from Jerome Powell. And to be honest with you guys, it was a bit of a nothing burger. So Powell says the economy is on firm footing and that the current rate level is not restrictive. There's a few key tone changes by Jerome Powell, but not much. Many of my colleagues think it's hard to look at the incoming data and say that policy is significantly restrictive at this time. What's he talking about? Well, he's talking about the fact that the labor market is not falling off a cliff, number one. He's talking about the fact that the US economy right now has very strong growth. So basically what he's saying is like, listen, if rates are still very high, but we are not crushing the labor market and we're not hindering economic expansion growth, well, then maybe we don't need to cut rates. That's basically what he means when he says things like that. Moving on a little bit further here, Powell says that the Fed can loosen policies once the prices fall. Powell said that once prices fall, the central bank would look to cut back on policy. He said he expects to see the effects of tariffs flowing through goods prices peaking and then starting to come down, assuming there are no new major tariff increases that are begun. And that's what we expect to see over the course of this year. If we see that, that would be something that tells us that we can loosen the policy. I mean, let's be honest, guys. The Fed has been deathly afraid of inflation for the past 3 years, initially with good reason, but in the past 6 months, it's kind of debatable as to whether or not they're being too fearful of inflation right now. I mean, when we take a look at the Truflation Index, which is 15 million goods and services measured on a daily basis, it's 1.16%. So I don't know what the possible impact of tariffs that they see could possibly be on the horizon, but are we going to go back up to 3-4% on this read right here? No, they're looking at CPI, they're looking at PCE. Those are arguably not the best metrics in my opinion. They're not the most real time, they're not the most up to date, and they're not the most broad. If I look at Truflation right here, I mean, I'm not the Fed, right? But still, I mean, can we argue that they're a bit too concerned for inflation? I do believe so. But then again, they do have a point, right? They don't want to run things a little bit too hot. They don't want to spur inflation. If you cut rates to, there's two camps, right? People want to see rate cuts to 2% just to favor more and more and more economic growth, right? But that comes with a possible negative. With that economic growth, are you possibly going to see inflation come back, right? Because people will feel wealthier. Well, if you look at most of the GDP gains recently, a lot of that has been due to the technology boom and the infrastructure boom. But the reason that consumer sentiment has been so soft and that consumers are so concerned with spending is that money is not necessarily trickling down to them, right? So at a certain point, I would expect the Fed to also see that as well and compromise in that respect in terms of the fact that they can cut rates because the GDP boom that you're currently seeing right now is kind of seen in tech and other infrastructure elements, but not necessarily into the consumer's pocket directly right now. So it's not as if they have the extra money to spend to really increase inflation. And you guys know excess inflation usually doesn't come from economic expansion that much. It comes from money printing, right? So let's just be completely honest on this video. So they are a little bit too concerned about inflation, in my opinion, but those are some of the highlights from Jerome Powell. I think there's one more that I got for you guys down here. Powell saying that the forecast is overall stronger since the last FOMC meeting. This is the only change. A bit of a hint towards the labor market, right? Powell said the growth outlooks seem stronger compared to when things were last year. If you look at the incoming data since the last meeting, there is clear improvement in the outlook for growth. Inflation performed about as expected, and as I mentioned, some of the labor market data come in suggesting evidence of stabilization. Once again, talking about the no hiring, no firing economy, right? If the labor market would have substantially weakened over the past 2-3 months, which has not been the case, well, you probably would have got a rate cut today. But the fact that it hasn't, well, also leads to the fact that there's not a rate cut today. So it's overall a stronger forecast, really. So talking about the fact that inflation is not here yet, but maybe it might come. The labor market is somewhat stable, but maybe the weakness might come. But the economic outlooks look very strong. So as a result, the Fed feels the need to once again just sit around and wait for things to break before potentially dropping rates or just keeping them high because they don't want to run things too hot. At least that's their logic, not mine. I'm just here to report the news. So that's everything for your Fed meeting recap here today, guys. Let's take a look at the indexes really quick. So we're going to keep this segment quite short because I know the video is already getting quite long and we haven't even done any charts yet. So the S&P, guys, I mean, there's not much to report right here, right? The line in the sand is still down here at about 677. So pay attention to it. You can see the futures are down a little bit, but you got a lot of cushion, right? This is literally a, let's call it 3% cushion on the SPY, and you got support right below 686 down to 679. The bulls do look like they're in control right now. You can get a higher low back test down here in my opinion, worst case short-term scenario, and possibly continue on to your way to $700 flat. The S&P is not looking too bad. It's just, you know, what's notable to us is that so far over the course of the past roughly 3-4 trading days, the rest of the market has pulled back in terms of breadth, and big tech has been holding you up. But there are no overall problems, right? We know that the macro backdrop still remains very strong. We just had very strong initial earnings from the big tech companies. So many companies from ASML to TSMC to Micron have told us that the AI boom is very real. All the highlights that I've been bringing to you guys over the past few weeks in terms of various news events have also pointed to that fact as well. So the AI megatrend is still definitely here. And then you have also very strong bullish tailwinds as well moving into this year. So I don't believe there's any red flags right now initially with the S&P, but just keep that in mind. If you get a bit of a pullback after, you know, maybe if some of these companies drop tomorrow, like if Tesla gives back its gains and, you know, if Microsoft continues its decline or Meta gives back some of its gains as well, well, you may just see a little bit of a slide, but it definitely wouldn't be something that's structurally wrong with some of these companies as we just covered their earnings, right? Moving on to the QQQs right now. The Qs tried to go. They tried to go for this October breakout, man. Couldn't get it done. So we are lower in the futures market right now. If you pull back, you got a nice size cushion, right? From here all the way down to the line in the sand, 4.5%. And you got a very nice, well, I mean, there's the initial touch zone right here. Call it 627 down to about 625, this little $2 pocket. But in all reality, they can use more of that space to set up a new higher low and try and go for the ever so elusive breakout of the past 3 months. I mean, there's nothing wrong with the indexes right now. It's just been a tightening range with a breakout attempt. If that doesn't happen, you may have to wait a little bit longer for it. But as I said, there's nothing structurally wrong with the markets right now in terms of major red flags or major misses in the fundamentals of these companies or anything of that nature. It just shows that they are still spending a lot of money for this AI trade and that a lot of the efficiency gains from the AI trade are here. Like the cloud services businesses and whatnot, like they're very strong. Like demand is very real, right? So keep that in mind. On to financials right now. Financials still a little bit flat, still a sector that I'm paying very close attention to. We know that tomorrow we have a few key earnings from some big players such as MasterCard and Visa, and thereafter you will get American Express and a little SOFI action on the Friday session. So keep that in mind. This could move financials, but even though we are in a daily downtrend here on financials, below our resistance range now, 54.38 to 53.25, understand what's going on right here. You're looking for a weekly higher low. If they come all the way back down here, this is probably the area where they stop the market, right? Huge previous resistance, huge previous support. This is not small, guys. This is like a year's worth of price action, right? So keep that in mind. Just looking for a monthly higher low as well. Some of the banks have been retracing, but nothing structurally wrong with them. We covered their earnings just a few short weeks ago at this point. They are all looking for monthly higher lows. There's Bank of America, JP Morgan also looking for their structural monthly higher lows, but there's nothing wrong with these companies Goldman Sachs pulling back a little bit off of their highs. Morgan Stanley pulling back a little bit from their highs, right? Charles Schwab a little bit too. I mean, everything was a little bit extended in the banking sector overall. Then you have insurance also not playing along. Insurance has been basically flat for the past, 12, 14 months at this point in time. And then the major credit card players have also been flat for the past roughly 12 months at this point. There's Visa, there's MasterCard, right? So when you have the banks pulling back and the other two biggest divisions, insurance doing nothing and the credit card companies doing nothing, well, it's tough for the XLF to move higher, but this is, in my opinion, a nice buying opportunity either for the credit card companies, some of the banks on a pullback, or just the XLF ETF as a whole. Moving on to XLV Healthcare right now. Healthcare down a little bit today, so maybe we see an unwind here. Line in the sand is 153.29. If you lose that, you lose the daily uptrend attempt, right? This was a daily downtrend. They tried to go for the reversal. Sadly, it appears that the bulls are now getting reversed as we're closing dangerously close to being below the 50-day EMA, which hasn't happened since September. If that does generate a bit of a rollover here and the bulls are tired and you go for more consolidation, it's the monthly, the ever so elusive monthly consolidation that I've been talking about many times on the channel as we have struggled to break out of this location, which is just previous all-time highs. If you struggle a little bit more and you got to go for a deeper retrace, well, you're looking for the monthly retrace down here, 148 down to about 144. This is the pocket where I'd be looking to pick up some healthcare. I probably wouldn't be doing individual companies. I might just play XLV overall. You guys know that I built some swing trade leaps down here, sold them there and into the all-time highs, which were our two price targets. If they give me re-entry, I might just nibble a little bit. If you do get that good old breakout or retest and policy run for 2026. On to semiconductors. Very strong day for semiconductors overall today. 2.3% to the upside as some of the bigger players participated again today. NVIDIA, Micron, Intel was up 11. TXN after their earnings yesterday, 10% to the upside, right? Some of your peripherals such as memory and other things of that nature. Very strong day again, right? And then some of your equipment manufacturers as well were also doing quite well today. So not too bad of a day, guys, but just keep in mind, right? Extension of the daily uptrend, higher lows are down here, 395. In the event you lose it, I'm pretty sure nobody's concerned about further expansion. You guys are concerned what happens if this happens, right? Well, absolutely nothing. It's just going to be looking for a weekly higher low. Super nice extension over the past 5-6 weeks with very strong earnings, let's be honest, right? And that being said, anything above 338.61, higher low, looking for further trend continuation. So maybe the next few trades will be available down here on a back test of previous highs, which would just be looking for swing trade support lows. Moving on to the Russell right now, the Russell pulling back a little bit for arguably the fourth day or fifth day in a row at this point in time. The line in the sand remains at 260. If you crack 260, that is the end of this leg of the daily uptrend, and you might give the bears a chance to consolidate. If that does happen, pay attention to the weekly, which is the clearest time frame in my opinion, guys. Looking for a weekly higher low, right? So if you're looking for more Russell entries, probably down here, 251 to about 248 would be probably the sweet spot to just backtest this one and maybe go for another little run. I'm not in the Russell personally, I'm in individual companies. But if you wanted to play the Russell, at least this would be the level that you would be looking for. We do a good job of covering a lot of these smaller companies at the end of the videos. So hopefully you guys have been able to get some nice hints or tips and tricks from our biggest gainers and losers sections, as we've spent a lot of time on those sections throughout the month of January. And also I've made so many videos about the 2026 themes and stocks that have been working so far and how to position and things of that nature, right? So moving into February, those types of videos will stop. I'll just take for granted that everybody knows by now, because I think I've made probably close to 9 or 10 videos on those types of themes and trades. So hopefully you guys now have a good idea of what you should be researching, or maybe how to best position to take advantage of some of the key themes throughout the early portion of this year so far. Moving on to gold. Gold, not only did gold have one of their best days since 2008 today, but in the after hours now up another 2.35%. Interesting statistic right here. The volatility index of the gold ETF relative to the volatility index of the 20-year Treasury bond ETF, TLT, hit the highest since 2008. Look at this, guys. This is the gold VIX right now. That is absolutely massive amounts of volatility in gold. And you usually don't see this, right? And you know what they say, right? Usually, if you're part of a exponential move like this, usually the most violent portion of it can be towards the end of it. It's just the problem is, you don't know exactly when it's going to end. So of course, the next price target for gold would be 6,000. I mean, they made super quick work. This is literally like a few weeks, right? We were literally just at 4,600. In just the last 2 weeks, you're already up 900 points, 20%. on gold, right? That usually doesn't happen. So this one is now running exponential. We've talked about many of the reasons why, right? Some people are calling for, the de-dollarization trade, or some people are talking about the structural deficits that you have in some of the critical minerals. Some people are talking about the central banking building up of gold, et cetera, et cetera, et cetera. We all know what are the key factors driving gold, but what nobody knows is since this is a non-productive asset, right? It's very hard to tell when this one's going to stop. It started as central bank accumulation and possibly a hedge to the dollar trade, but I think this is kind of turning into a lot of retail squeeze as well at the current stage, at least in this final maybe leg of exponential expansion, at least in the short term, right? So super solid move on gold, but I've been saying this for a while, right? It's so tough to chase this with size. I mean, if we would have been in from previously from the 2000s or even from the 3000s, arguably in any market, right? This is an area where taking profits is just the logical thing to do. Can it rally higher? Of course it can rally higher, guys. It's an exponential squeeze or whatever you want to call it right now, right? A parabolic move, the likes of which you've only ever seen twice before, right? Once was in the 1970s, and then the other one that people often reference is this one right here coming out of the great financial crisis. But it's not as if you have a very large data set of points in time in history where this has happened to gold, right? So keep that in mind. So winding down some bets here on gold, not a bad proposition. But if you guys are staying in with the full bag and saying, no, I think it's going to go to 10,000, I mean, I wish you the best of luck, right? I guess we'll just have to see and find out that on our own. All I can say here is the bulls are in full control. Any retrace here above 45.35 is looking for a higher low. Just take a look at your 12 EMA. If we ever come back down there, everything's overbought, guys. The daily is overbought on the RSI. The weekly is overbought on the RSI. The monthly is at the highest RSI that you've ever seen on gold, like almost ever. As a matter of fact, ever on gold, unless you go back to these data points that barely even exist in the 1960s, right? But still, like in recent times with electronic trading and all that stuff, you're at the highest levels of RSI that you've ever seen. So can it keep going higher? Yes, but should we possibly exert some caution up here? Yes, as well, right? Nobody ever went broke taking profits, right? And this is just getting super, super greedy, especially if you're holding a very large bag from previous prices, right? If you're just day trading or whatnot, I completely understand if you have your defined levels. And the same thing can be said about, same thing can be said about silver as well, right? Silver, we're not going to spend so much time talking about these moving forward, guys, because I think you guys get the impression right now, right? No matter how much the mercantile exchanges raises their premiums or raises the liquidity requirements or the margin requirements for these trades, it doesn't matter. Retail just buys every single dip, trying to squeeze the dealers, right? And just, we can argue with production and things like that. Matter of fact, I have another statistic for you in terms of silver, right? Silver now reflects a record 29% of total solar panel production costs. Solar panel production costs are skyrocketing due to silver, but silver is in a lot of things, right? It's in certain forms of batteries, certain forms of connectivity, EVs, certain industrial applications and whatnot. And here's a comparison in proportion, right? Percentage of cost for average solar panel, right? Silver, it's just more and more now, right? So, right, is there a difference between the spot price and the electronic price? Yes. Are there industrial applications? Yes. Is there a structural deficit of silver? Yes. Have JP Morgan and other firms have been artificially suppressing silver for the past few years? Yes. Everybody knows all this stuff, guys, right? These are all known facts. Fact of the matter is, it's an exponential parabolic move, parabolic squeeze. Does it show any indication that the dollar is collapsing and that there's going to be a massive exodus out of the US economy and that we're about to have a massive global recession to the likes of which nobody's ever seen before? I wouldn't go that far. That's kind of like putting on the tinfoil hat a little bit too much, in my opinion, right? That being said, very powerful move. Congratulations to all silver holders out there. Higher lows are set, $90. Any move come down into there, probably looking for a 12 EMA tag. And don't say it's not going to happen. It always has happened on silver, at least from the moment of time that everybody started being interested in this trade, right? It's just you're very extended on everything. You're super extended on the RSI on the monthly. It's a 95. Super extended on the RSI on the weekly. Super extended on the RSI on the daily. I know that might not mean anything to some of you guys, but when you hit these historical prices, right? Is it a time, the question you should be asking yourself is it a time to be buying right now, or is it a time to be selling, right? Arguably, it's more, the scales are tilting from to hold to sell, right? At least you can agree with me that you're not early anymore, right? So if you're expecting to have the same gains in silver as people who bought back here, if you're buying up here, you may be grossly disappointed. That's all I have to say, right? But maybe we'll see. Maybe I'm wrong. Maybe silver goes to $1,000 per ounce. I guess we'll see, right? Moving on to Bitcoin right now. Bitcoin down 0.8%. There's really nothing to talk about on these charts overall. They've just been dead, completely dead right now, right? So nothing to report on crypto. I'm not going to spend too much time on it. You need to find a new daily uptrend. Only then we'll be able to say, all right, the bulls have a little bit of juice here to go for the weekly uptrend shift. That would be a break and close above 94,800. So far, that hasn't happened. Crypto doing a whole bunch of nothing. And it's very funny, right? This trade was supposed to be, and I say this as someone who owns Bitcoin for the long term and Ethereum as well, right? Crypto was supposed to be the antithesis for the dollar, right? If the dollar was supposed to crash and de-dollarization was supposed to happen, which is why the metals are running, Bitcoin was supposed to be that trade, wasn't it? But it's very funny, right? Gold and silver have been doing all the heavy lifting, and Bitcoin and crypto has just been nowhere to be found. So is that entire thesis underwater right now? I'll leave you to be the judge of that right now. But suffice to say, the price action has been very unfavorable in crypto overall. Ethereum is also locked in a range, 33 down to 2,800. Unless it breaks either way, guys, there's really nothing much to report right here. So I'll kind of just skip over them. Price action is quite uninteresting in my opinion. Until we have a daily uptrend and an attempt at a weekly breakout, it's very tough for me to go for some swing trade longs with some size, unless you just want to call this a bottom and set stop losses below it and just say that, yeah, we're going to rally from here. You can do that. It's an attempt, right? But please trade with a stop loss, because if ever you flush, you are going a deep level lower on Bitcoin, 75 to 70, and on Ethereum, that would be synonymous with 25 down about 22. So please trade with a stop loss if you are taking that attempt without confirmation of your trend changes in motion. That being said, that's everything I had for you guys in the overall market rundown. Now let's cover big tech. And I don't even think we might have time for the biggest gainers and losers today. Not that there was anything different to report than all the other times we've covered this list in the past few weeks. The themes are all the same. The names are all the same. You guys probably know my opinions on most of this stuff, right? So keep that in mind. I'll do more of it tomorrow, because tomorrow, what we're going to do, just for me to get it out there, right? Tomorrow, we'll do Visa and MasterCard really quickly, okay? We'll spend a bit more time on Apple, and I may even do SanDisk, but it shouldn't take as long as the big tech earnings today, okay? So tomorrow, we'll have more time to describe what's going on in this list right here and see if there's any plays, but today, I might just not have the time. I do apologize for that, but I spent half an hour doing this list yesterday. So if you're curious, maybe you'll find some names that you're curious about if you go watch yesterday's video, last half hour. I know that's me asking a lot to go watch another half hour on top of today's hour and 10 minute, soon to be hour and 20 minute video. But that's just the way my videos are structured, I guess, right? So moving on to Apple. Well, to be honest with you guys, there's not much to report on Apple. Apple is going to move about 3-4% after their earnings tomorrow after the close, so we'll just have to find out, right? The only thing I can say is that in the event Apple revisits this lower 240 to 230 zone, it would be a buy for me. On the monthly time frame, it's just looking like a very gorgeous breakout retest overall. The focus of tomorrow's earnings, guys, is going to be on the iPhone revenue. I think they're going to crush it on their new suite of products coming out this year, which should be good as well. And on the rollout of Siri, the new AI Siri, which is supported heavily by Gemini, of course, as well. We'll cover all that on the channel tomorrow, but no positions for me. I'm going to wait until Apple actually reports their earnings. Just pay attention to it, though. If you break down, it's going to be a nice opportunity. We'll cover it tomorrow. And if you break up higher, above earnings, well, trade is kind of came and gone at that point in time. But we'll cover more of Apple. No sense of me making any predictions into it. All I have to say is pay special attention to those numbers tomorrow. But anyways, I mean, I don't know why I'm saying that. I'll be giving them to you guys on the channel. So we'll kind of have to wrap it up then. AMD right now, I mean, if there is one big winner from Microsoft's CapEx guide, from Meta's CapEx guide, from what Tesla said as well on their earnings call, how they're focusing more on building out compute and that they don't want to sell compute to anybody because they need all of it for themselves and they need even more. The biggest winners are clearly still the semiconductor companies, namely the ones that provide the chips, talking about AMD and NVIDIA. So AMD and NVIDIA were actually up a little bit in the after hours before giving back some of their gains, but after the earnings calls, they were definitely up. That being said, AMD all the way up here, rejection from the highs. If we get a swing low attempt, you're probably coming right back down here to about 230. I mean, I could put a line right here, or maybe I could put a little box. You'll see it. It's not that big of a level, but it's the closest one that we have, right? It's most of your price action lows from this area. It's most of your price action highs from this area, and all the moving averages on the daily would be there as well. That would be the retest area, in my humble opinion, if they do choose that course of action. Keep in mind, AMD has earnings next Tuesday, I believe. So not too many days of action before they report earnings. Weekly breakout is looking very solid. And once again, I mean, if anything, right, these big tech earnings just reiterated how strong AMD is going to be probably over the next few years. EPS ramp is very real. The margin expansion and free cash flow expansion is very real. The revenue expansion thesis is very real. So as a result, AMD 250 down to 230 is indeed still a buy, but it's kind of like last call here. If you're looking for the most optimal risk to reward, best, we talked about it was 200. I don't think they'll fall back to 200. I think their earnings will be quite good. It won't fall back to 200 unless you have either a very poor earnings release, which would surprise me, or a big macro catalyst that just hits the market. So 230 would be the point of interest for AMD. That being said, at 250, is it still decently valued right here? I think so. It's trading about a 1 peg on a forward basis for all of this growth. Not too bad. Moving on to Amazon right now. Amazon down 0.68% today. We'll see what happens. Amazon has earnings next Thursday, so I'm not really expecting Amazon to break above their all-time highs before then, but I'm also not expecting them to crash down here sub 220, so we might just be stuck in this price action range. Any revisits of this area, 240 down to 228, could be notable for us for either some short puts under the market or further accumulation of some shares. You guys know my stance on Amazon. Amazon just building a very attractive base of monthly support right here. It's a big accumulation range. This is a retail fan favorite trade. It's an institutional favorite trade as well. I think their earnings will be very strong. And at 235, they're slightly above that. But if we revisit the mid 230s, if you're interested, it's under a 34 price to earnings and a 1.5 peg. Very strong. One of my favorite tech companies for 2026. On to Google right now. Google will have their earnings also next week, so we'll just have to pay attention to that. Today, they didn't lose too much ground, and in the after hours, they were up a little bit after those earnings, partially because of Meta's booming advertising revenue. And you guys know Google is a very strong advertising company, so if Meta's earnings gives us any indication, it should be that Google's earnings are going to be strong. Line in the sand level remains 320, so just watch it. In my opinion, I don't think we're going to massively rally above the all-time highs before earnings. And I also don't think we're going to break down into the low 300s. We may just be trapped here in the, let's call it 330s to about 320 range, or rather maybe they get a break, right? 340 down to 320, this little 20-point range right there. That's where you may just kind of sit sideways here until Google's earnings. I think Google will have very strong earnings, but they are extended on the time frames right here. Very extended on the weekly, extended on the monthly as well. So net new longs up here, tough proposition. The risk reward isn't there in my opinion, but I am holding my long-term shares. I'm just not adding any more. Moving on to Meta. I mean, we already covered Meta after their earnings are up here to 715. You're going to leave a big gap behind you, right? That being said, if you retest the gap, this would probably be for some swing trade entry longs. The support range would be 705 down to about 680. So pay attention to that. If you're looking for swing trade longs, retesting this area on Meta might just be last chance to dance for this stock if you're looking to take it into the rest of 2026 for investment purposes. We covered their earnings. The stock is decently priced, still in the low 700s range, and we are currently embarking on a possible very nice next monthly upswing for the company overall. Microsoft, we already covered this one as well. We're not going to spend too much time on it, but just understand who's in control of the monthly timeframes here. It is still your bulls looking for a monthly higher low into previous resistance, current support, valuation we covered on their earnings earlier in the video. Valuation is very fair. Nothing fundamentally wrong with Microsoft. So yes, this dip into the 450, 440, 430 region is the sweet spot for me to buy. Every time we come into the 26 EMA and that we're 20% off the highs, guys, it is usually a very nice proposition to be buying Microsoft, especially if there's nothing fundamentally wrong with the company and the company is still somewhat fairly valued, in my opinion. Fair value for Microsoft probably sits closer to about 550. So we are getting a pretty nice discount here in the after hours since it's already back down to the 450 lows. Moving on to Netflix right now. Nothing to report on Netflix either. Down 1.10%. I don't think Netflix is going to move substantially. I mean, you may get a drop of a couple percentage points to the downside. If you do drop a little bit more on Netflix, this company has been down 10 weeks in a row. So, it's weekly oversold conditions. It keeps oscillating oversold conditions as well. But people just aren't interested because there's a lot of cloudiness surrounding the Warner Brothers Discovery deal. Now, that being said, guys, right, the next area of interest would be probably down here around like 75. And it is a buy for me here all the way through 75. They rarely ever test. This is the monthly 50 EMA, right? The only time they tested that before and flushed it was 2022, but that was a very different landscape. In all other bear markets, if you're buying around the 26 or below the 26, right, it's always been a nice buying opportunity. Now, whether or not they instantly turn around, that's probably not going to be the case, okay? Just because we're going to need more visibility, and that deal will probably only be finalized per the company's guidance, maybe even early in March. So I'm not saying that it'll just be a destruction of Netflix until then, or that we're going to have a massive rally. We might just get stuck down here for the time being. But as of right now, no daily uptrends. If you really want to see Netflix come alive, you gotta break and close above this daily 12 EMA at least and give me a daily uptrend. Then we can say, all right, a weekly low has been set. Now we're gonna look for the size of the bounce and try to reverse some time frames. But as of right now, indeed, it is still somewhat of a falling knife. The thing is, though, the valuation down here is compelling for long-term investments if you are a fan of the company. On to NVIDIA right now, 1.59% during regular hours, and they had it after hours. Unfortunately, they slid a little bit. However, NVIDIA is probably going to be a very big winner. You guys know the drill on this one, right? Company is relatively cheap down here, low 180s to mid 170s. It's a low 20s forward multiple right there. It's a one peg, very strong revenue and EPS growth, and NVIDIA's guidance for this year is absolutely amazing. It's just monthly consolidation. So if we find a revisit down here, you guys know the drill. I'm building some leap positions here, building some shares, but also selling some short puts, in the under 180 range, call it like, 175 down to 170 support lows down there. As of right now, they're trying to go for the breakout. We will see if they have to backtest this location again before maybe going for it and then rallying. But today's earnings from the mega caps definitely did say that NVIDIA's products will be very much in demand for the next few years. So I do think fair value for NVIDIA sits probably closer to 250, 270. It's just we're kind of pending the ever so elusive breakout. Moving on to Tesla right now. We already covered them after earnings, but one time frame that's going to be key to pay attention to is this weekly. The daily is kind of all over the place. It's stuck between two levels: overhead resistance 460 to 445, and below support, which is 426 down to 417. Keep that in mind. It's trapped here. The daily action is kind of awkward. If you really want to see some momentum, give me a break above 460. Then you get some good momentum. The weekly, still trying to find a weekly higher low, right? And on the monthly as well, still just monthly consolidation. It's a beautiful monthly uptrend with a lot of momentum. But the past 3-4 months, Tesla, just like many other big tech stocks, hasn't really done much. We're still consolidating. Best, if you're a long-term investor on Tesla or you're looking for maybe a swing trade, would be from these lows right here, 400 down to 380. I don't know if it happens, but that would probably be the optimal location to kind of revisit some larger entry longs. Or see, that's the flush location. If you want the breakout location, you got to give me a break above, retest 460, then we can set an accurate stop loss, right? Break above from here and retest, then I can put my stop loss below these lows, and then we can go for the breakout towards 500. But, from here, it's kind of very mixed price action. On to Palantir. Palantir was down 5% today, okay? For no specific reason whatsoever, but a lot of software companies were also down today. CRM was down today again. Adobe was down. Oh, sorry. I was about to say they were down, but they actually managed to end up green today, right? But software has just been a disaster. We didn't cover ServiceNow. ServiceNow just reported very good earnings. They beat on EPS. They beat on revenue. There was nothing wrong with this company's earnings. Guess what happened in the after hours? Can you guess? Well, obviously, they went down 5%, didn't they, right? So software just unloved. And now even Palantir, the leader of the pack. You know what's funny is that Palantir is arguably the most pure play AI software out there. They can't be disrupted by AI. They are AI. But still, this one's getting lumped up in the software trade. How else can you explain it, right? Well, maybe you can explain it such as people are taking gains from 2025 and rotating into different things. You can say that maybe people are finally coming, maybe people are finally realizing the valuation, doesn't quite make sense all the way up here. There could be a whole host of reasons, but I just find it very funny that Palantir is down 5% on the day off of no news. Just goes to show you, man, that sometimes when things are in consolidation mode, the consolidation can last for more than some people are comfortable with. Next stop for Palantir, if we truly break below, because there's nothing really holding us down here, right? Coming to the 200-day EMA, the next area of interest is down here, 150 to 140. This little pocket right there culminating in the 12-month EMA. Palantir's done this one time before, well, a few times before, but more recently during the tariff sell-off, right? Palantir's earnings next Monday. I do believe they will have fantastic earnings. Will they be able to eclipse last earnings, which are some of the best earnings that the market has ever seen for any company in the history of the markets? I don't know. Those are very tough comparable numbers to beat, right? I do think they'll have very solid earnings. I don't think there will be any problems with the business whatsoever. However, if expectations are just too high, could we see it consolidate into a final retracement down here? The answer indeed is possibly, right? it's not, you can't say categorically no anymore. The answer is quite possibly, and I might revisit some trade opportunities if we do come down there. SOFI has earnings on Friday. SOFI breaking down 3.38% today for no reason other than the fact that financials have been a little bit soft, right? You can see the banks have been consolidating, credit card companies, they've been consolidating, right? Robinhood, if you want to compare it to other brokerages, Robinhood has been consolidating as well. If you want to compare it to other fintech stocks, now I'm not putting SOFI in the same category as PayPal. I would never do that to you guys, of course, right? But it's just everything fintech today. I mean, look at Affirm, right? That's not SOFI, but still, even Affirm down 5% today. Why? No news, just normal price action, I guess, right? Their earnings are on Friday. SOFI expected move for Friday is about 10% either direction. So 10% higher would put you right back into resistance, 28 to 30. Anthony Noto, the CEO, is going to have to give pretty firm guidance if you do want to see a nice 10% push. I think they're going to have good earnings. I think they'll show user growth. I think they'll show product growth. I think they'll show nice improvements in EPS and good revenue guidance. But we just saw from Microsoft, right? Sometimes that doesn't mean anything. Sometimes the market can still send you down regardless. If they do send it down, the bottom end of support down here is about a 22. So keep that in mind. The bears do control the trend right now, but earnings, it's 10% either way, right? You can easily reverse this trend right here, but you will still be stuck below support. If you really want to see SOFI start to break out, you're going to have to break and close above here. Then you can start saying, all right, we got to confirm breakout. But notice no weekly candles ever closed above this range. However, if we're looking to accumulate SOFI, if we're a long-term investor, in my opinion, there's no better area to do it than into this big box right here, previous resistance, current support for the markets. So here, down through the low 20s, decent area. We did the valuation at 27, just take 10% off of this, and now they're trading right around a 1 peg and under a 7 forward price of sales. You know, the market cap right now is 30 billion. And I also believe that SOFI eventually is going to be a $50, $60 billion plus company. So the risk reward is still quite compelling. Not as compelling as it once was in the $10 to $8 range or $5 to $6 range, but still somewhat compelling. Moving on to Uber right now, Uber down 1.8% for also no reason whatsoever, but they did round trip this entire move right there, and Uber has earnings next Wednesday. So I'm not expecting a massive flush on Uber, nor am I expecting a recapture of resistance up here before their earnings. We will just have to wait. That being said, short-term bears, full control, weekly bears, also full control of this chart right here into our very big monthly support range, which culminates pretty much at the low 70s location right down there, big previous resistance, current support for the markets. We will see if Uber bulls are able to bottom out this chart after 4 months of consolidation. We will see if they have it in them with their earnings to probably send us up to the upside, but decent buying opportunity down here, low 20 multiple and a 1.43 peg. And last but not least, TSM. TSM up 1.17% today. I mean, we'll see what happens into tomorrow, but TSM provided us some great visibility. We said that after earnings a few weeks ago, right? Great visibility through 2029, raising revenue expectations from 20% per year growth to 25% per year growth. Valuation at 340 is not too bad. It's a 26 forward PE, a 1.37 peg, and a 9 forward price of sales. So the valuation is not very stretched. But then again, they never really run more than that because there's always the threat of China. Although they do have a lot of production now in the United States, it's just something that is an overhang for this company, which is why you don't see it running at a 35, 40 forward multiple like some of the other semiconductor companies out there. But it's a very solid business. The line in the sand is 325.46. If you somehow reverse this, well, no problem at all. It's going to look like SMH, right? You're just going to head for a bit of a weekly higher low. Down here, 310 at about 300 would be the pocket in which we could explore possibly further swing trade longs, but nothing up here from me. I'm not buying any more TSM up here. I'm just holding what I have currently. But that being said, the valuation isn't too expensive, all things considered. That's everything that I had for you guys today. So hopefully you guys enjoyed today's video. If you did, we don't have time to cover these guys, right? Just watch yesterday's video. I spent 30 minutes going through a lot of these companies, a lot of these themes on this list. Sadly, now we spent a lot of time on earnings, so I just don't have the time. So hopefully you guys enjoyed today's video. If you did, consider dropping a like. Consider subscribing to the channel if you're new. We do these every Monday to Friday after the close. And last but not least, if you have any questions, comments, feedback, or anything in between, please leave a comment down below. It really helps me to grow the channel. And additionally, guys, if you were tired of trading and investing in the markets all by yourself, and you wanted to do so as part of a group of over 350 investors, you might consider joining our community. The link to join us is down below in the video description. That is the best place to ask me, what are my thoughts on this stock? If I want to play this stock, how can I do it? Which options should I choose? What are the support levels? What's the valuation look like? What should I look for fundamentally in this style of a company, right? You can ask me all those questions either in our chat rooms or in our live streams. I live stream every morning for about 2 hours at the open. I trade live with you guys, and then I take all of your questions on your stocks, your options, and your long-term portfolios. So if you want to discuss stocks, if you want to discuss themes, if you want to discuss existing trades, that is the best place to ask me, of course. I also share all of my trades live or all of my long-term investments, whether those are large cap, high quality compounding companies or some of the small or mid cap plays that we've been building for this year as well. So make sure to check out everything that you get in our Discord by clicking the link down below in the video description. It'll take you right there. I'm looking forward to seeing a few more of you guys in our group soon. And if not, I guess I will see you right back here on the channel. Take care. That's it for me, guys. Much love. Have a good day in the markets tomorrow, and I will see you again for another big earnings day. That's it for me. Peace.